Hi again, everyone. I hope you're all doing really well. For us holders of Wish stock, yesterday was a tough day. The stock fell 9.35% on the day to close the session at $4.85, setting a new record low. ContextLogic got hit with a devastating combination of a poor market analyst update from Oppenheimer and very weak market performance, particularly for tech stocks in general yesterday, which, let's face it, it was not helped by Facebook shitting the bed and ruining the life of Instagram influencers globally who were unable to do their job of posting pictures of themselves drinking coffee in yoga pants. Pull your finger out, Mark, switch it off and on again and get back to business.
Hello, IT? Have you tried turning it off and on again?
Anyway, so what I want to do in this video is take a little bit of a look at the Oppenheimer comments and how Wish stock is performing in general, and lay out my thoughts for the stock going into the future. This video is going to be more of a discussion around these developments rather than some of the technical chart wizardry that I usually expose you guys to, so let's get into it. So to start with, let's look at the main points that came out in the release from analyst Oppenheimer as appeared on the MarketWatch website. He goes, Wish is facing a perfect storm of negative challenges in the coming months. The rating was cut to underperform from perform, and a $4 price target was set. They blamed China accounted for substantially all marketplace logistics in financial year 2020, so they're obviously hinting that there's some problems there, and there is linked to that obviously the high increase in shipping costs, and they also mentioned some problems that ContextLogic has been having with advertising costs. So in general here, the two big issues cited are the increase in shipping costs and the continued elevated costs the company is sustaining from marketing. So I do want to pull these points apart a little bit, starting with the shipping. Much has been made about the shipping costs and logistics bottlenecks facing the world since the pandemic started. This is causing problems as more and more people have been ordering online. Currently, half of my native Australia is living in lockdown, and there have been a few instances where the postal service was not picking up mail for several days to try and get on top of the backlog that has been driven by increased e-commerce activity. To me, this is actually a promising sign. People want to order online even more. Hopefully, like in true textbook economic style, we see this increased demand for online ordering and the associated bottlenecks as a catalyst to enhance competition in the logistics space and possibly even some innovation, which will ultimately be a big win for ContextLogic if they can get this right. The other element of the shipping woes is connected to the growing global tensions with China, which I think is only acting to further exacerbate investor sentiment. The thought that conflict and tension with China means that the Communist Party will start withholding our online orders of cheap goods from Wish, to me at least, seems like a bit of a stretch. Cutting off this source of revenue is the last thing China wants to do for its businesses, especially given the problems the country's economy is facing with its property sector at present, a sector which represents a more significant part of the country's economic development. So I don't think they want to hurt themselves even more. I think this unease around China may be weighing a bit on investors' minds, particularly those of Wish stock, but honestly, I think it's a bit unfounded. Speaking further on the tension with China, arguably one of the losers from the escalating tensions has been Alibaba and by extension AliExpress, which is a very similar platform to Wish and realistically is one of their main competitors at this stage. I know a lot of people like to compare Wish to Amazon, but I think AliExpress is actually probably the much better comparison to make. Anyway, government imposed restrictions on Alibaba as well as the degree of distrust that has been growing towards Chinese companies in general lately around the world, and the sense of foreigners users of AliExpress may experience when shopping with their app, has hurt AliExpress's ability to properly dominate the discount market space as they might like to. Enter Wish. Wish, being an American-based company, is able to take advantage of the shortcomings of Alibaba and make for a better user experience. As such, Wish also provides an important conduit for the businesses who would also sell on Alibaba in China, and as such, I can't see them being banned by the Great Firewall of China anytime soon. They're just too important for the growth and sustainability for many of these businesses, so I just don't see it happening. It's also worth remembering that it's not just Chinese merchants which are selling on Wish. Wish gives market access to a large number of retailers globally, and yesterday the company attempted to throw a market counterpunch to the hits it was taking with the announcement of strengthening its positions in Spain through giving about 8,000 Spanish merchants greater access to cross-border tracked shipping opportunities. So while Oppenheimer flagged the shipping bottlenecks as one of the concerns for ContextLogic, it's clear the company is putting in a great effort to iron out the kinks in their systems where they can. So it is an issue that is being worked through, both by ContextLogic and by the world as a whole. On to marketing costs. Ever since Wish paid $30 million to appear on the Los Angeles Lakers jersey, they had announced themselves as a big spender on marketing. This is something that has only accelerated since they went public, and I suspect getting access to capital markets to fund this sort of growth may have been central to these plans. I suppose there is a degree of thinking about the company that eventually they won't need to worry about advertising as much once they get widespread popularity and a strong returning user base. Being a relatively newcomer to the e-commerce world, the continued elevated spending on marketing is perhaps one of the hardest elements of business operations to grapple with as an investor. You see all these strong revenue figures being wiped out by the growing costs of marketing, and then when you factor in the cost of shipping that they're currently having to put up with, you have to ask yourself, when will this all finish? I do believe it is hard to pass judgment on the effectiveness of this type of spending at the moment, and if I'm being honest, it's a painful belief to have as well. Oppenheimer flagged the continued costs associated with marketing in Q3 for the company. I think that ContextLogic is a longer term play, however, as is their marketing plan. As a result, given how the general merchandise retail cycle works, Wish won't see their best sales figures until Q4 and Q1. So while it looks like the company is likely to show continued bleeding through marketing costs in Q3, as they did in Q2, the big question is, will these costs pay metaphoric dividends for the company with stronger company performance in those important Q4 and Q1 periods, by hopefully bringing a stronger returning customer base to the platform? That's the big question. I expect to see some improvement for the company on the horizon, and that is the risk I'm taking with continuing to accrue and hold this stock. The last little bit of negative news I want to address that came out about the stock from Oppenheimer was the $4 price target they put on ContextLogic for the next 12 months. That's pretty scary, as it means they're expecting a further shedding of 85 cents or almost another 20% on where the stock price is at the moment, so it's a fairly scary prospect. However, it is worth noting that of the major brokers covering the stock, only 2 have a sell rating for an overall consensus to hold the stock. It will be interesting to see what the drastic cut does to the overall average share price target of analysts, which was last calculated to be at $18 per share about 3 months ago. If I've done my maths correctly, this $4 target from Oppenheimer brings the average price target down to $16.72 per share. So it's not a huge negative revision, and at the current share price still looks quite promising. What will be worth doing is having a look further to see if Oppenheimer has any stake or short positions out against Wish, as well as keeping an eye out for whether any other analysts do a subsequent downgrade on ContextLogic, just to get a better feel for how the big dogs are feeling about all this. Anyway, that's about all I will cover for this one. I know I have kept this video more qualitative rather than looking at the technicals behind the stock. If you want to check those out, it looks a little bit like this. It's a downward motion. What do you guys think about the stock? Do you think the $4 price target is a gross underestimate of the value of the company? Or is ContextLogic actually on the slippery slope down? Let me know what your thoughts are in the comments below. I'm really curious to see. Until next time, may the markets trade in your favor. Cheers.